You've seen a balance sheet before. Heck, we even introduced you to it in Chapter 1. But now let's show you what real-life companies do, and they create what's called a classified balance sheet. And we're not trying to be tricky here. A classified balance sheet is one that just puts assets and liabilities into specific categories. Mainly, you're going to see assets listed as current and liabilities listed as current, which means within 1 year. And you're going to have long-term assets and liabilities, more than 1 year. But let's dive a little bit deeper here. First, we need to get used to this term liquidity. Liquidity is how fast we can turn something into cash. Now, in my wallet right here, where is it? Right here, I have a $20 bill. That is a liquid asset because it's already cash. However, let's say the building that I'm in, and I'm in Granger Hall right now, that is a illiquid asset because it would probably take UW-Madison several months, if not longer, to sell a building. So liquidity is a measure of how fast you can turn an asset quickly into cash. And you'll see that coming up on why that's important on the balance sheet. So for assets, a current asset is one that's expected to be converted into cash, sold, or used in the next 12 months. Now, your textbook has a super duper official definition saying that a current asset also could be within a business's normal operating cycle, if that operating cycle is longer than a year. But we're going to ignore that, and we're just going to focus on the 12 months or less is a current asset. So, for example, cash. Well, yeah, cash is a current asset because it's already cash. Accounts receivable is a current asset typically because you normally collect on receivables within 1, 2, or 3 months. Supplies is normally listed as a current asset because you use supplies pretty quickly. And things like prepaid insurance. As long as the insurance is prepaid and it's only going to cover the next 12 months or less, that would be an example of a current asset. Another example would be for a merchandiser, merchandise inventory. Hopefully, when you walk into Target or Walmart and you buy something on the shelf, hopefully it hasn't been sitting there for the last 4 years. So typically, merchandise inventory for merchandising companies would be a current asset as well, being turned into cash within 12 months or less. A long-term asset is one that is not going to be turned into cash or used in the next 12 months. Some examples are long-term investments. Any investments like stocks and bonds that companies plan on holding onto for more than a 1 year period of time. Plant assets like land and equipment and buildings and furniture are all examples of long-term assets that are not current. And something we'll get into later on in this course, something called intangible assets. Those that give companies a special benefit, but you can't touch and feel them, like equipment and buildings. Some examples are patents, copyrights for music or books, and trademarks as well. A current liability, then on the flip side, is one that needs to be paid within the next 12 months. Accounts payable is a very common example of a current liability. Notes payable, any type of loan that we owe back in the next 12 months. Salaries payable, your workers probably don't want to get paid, 2 years down the road. You typically pay salaries pretty quickly. Interest payable, unearned revenue are all examples of liabilities we owe in the next 12 months or less. Also, any portion of a long-term debt. So maybe your parents own a house. They have a 30-year mortgage to pay off that house, so they make monthly payments. Any of the monthly payments that are due in the next 12 months, that would be a current liability, even though the entire loan length is 30 years. And then you got long-term liabilities, which are liabilities that don't need to be paid within 1 year's period of time. So for an example, a loan that is greater than 1 year, that would be a long-term liability. And then we have stockholders' equity. This represents the claims to a company's assets of a business. And this might look familiar to you, where we take stockholders' equity and we break it into 2 different sections. One section is called common stock. That keeps track of the amount raised from investors in buying the company's stock. And then we have retained earnings, which is your net income built up year after year after year, minus any dividends. So here's a screenshot of a classified balance sheet from Chapter 3 of your textbook for snowboarding components. You've got your categories in black. You've got current assets, long-term investments, plant assets, and intangible assets. One thing I really want to point out is current assets are always listed in order of liquidity, how fast Snowboarding Components thinks they can turn it into cash. That's why cash is always first. Receivables second. We probably collect on receivables within a month or two. Merchandise inventory third, because it might take maybe a couple of weeks or a couple of months or so to sell our merchandise inventory off our shelves. And then towards the bottom, you'd see things like supplies and prepaid insurance. You've got your long-term investments next. You've got your investments in stocks and bonds they plan on holding on to for more than a year's period of time. And a note receivable. That's considered a long-term investment because we're going to receive hopefully the money back from the person we loaned the money to, plus any interest on top of it. And that's due within 3 years. Here's our plant assets, and yep, there's that darn accumulated depreciation. Equipment, minus how much it's depreciated so far, gets us its book value of $150,200. Remember, land is never depreciated. And then lastly is your intangible assets. And then we have our liabilities. We've got current, those due within the next 12 months. And we've got our long-term. There's no hard and fast rule on what order you put current liabilities in. It's not as picky as our current assets. Remember, one more time, current assets, we put them in order of liquidity. Current liabilities, we don't really have to put them in any specific order. We got our long-term notes payable due 10 years from now, and then our equity section, we've got common stock and retained earnings. So that's a snapshot of a classified balance sheet where we take our assets and liabilities and put them into different categories. And when you start seeing real-life financial statements in this class later on, you'll see them in a classified balance sheet format.